Hey everyone, welcome. If you've ever wondered whether you can tap into your retirement account before retirement without getting slammed with taxes and penalties, today's topic is for you. We are diving into a big question we get all the time. Can you borrow money from a self-directed 401k, also known as a self-directed solo 401k? Now, here's the twist. Most traditional 401ks don't offer participant loans at all. But with the self-directed solo 401k, you've got far more control. We'll break down exactly how the checkbook control feature works, so you are in the driver's seat when it comes to both investing and borrowing. Plus, what's with this $50,000 limit everyone talks about? We'll unpack where that number comes from and how and when it applies. As always, shoot over questions you have during today's live webinar. It doesn't have to be specific to today's topic, which is, can you borrow money from a self-directed 401k? You can also ask questions about all aspects of solo 401ks, self-directed IRAs, and even traditional 401k plans. Please also like our video, subscribe to our channel for more videos like this, and help get the word out to other solopreneurs like yourself. Again, we'll pause as questions come in, so go ahead and type over any questions you have during the live webinar here, and we'll answer those as they come in. So here's what we are going to cover today. IRS rules for self-directed solo 401k loans. So the rules for self-directed 401k loans come down to IRS statutory regulations, which means the rules are the same across all 401k plans, whether a traditional 401k or a self-directed 401k. One, you need to make sure that the plan allows for participant loans. Not all plans allow for 401k participant loans. For example, Fidelity and Schwab both offer a self-directed solo 401k. However, it does not allow for participant loans. Whereas a self-directed solo 401k, also known as a self-directed 401k from a solo 401k provider like my solo 401k financial, does allow for 401k participant loans. So that's number one. The first rule is that you need to make sure that the 401k that you open allows for 401k participant loans. More rules regarding the self-directed, aka solo 401k participant loan rules are as follows. One, that loan has to be documented pursuant to the IRS regulations. In other words, you can't just write up a loan document or jot it down on the back of an envelope. You have to have specific loan documents prepared that have specific IRS regulations spelled out. You also need to have a loan payment amortization schedule prepared. The good news is that here at my solo 401k financial, our plan does allow for solo 401k participant loans, and B, we prepare those 401k participant loans as part of the process, and C, we don't charge additional fees for preparing those loan documents, that's all covered in our pricing. It's covered in our flat annual fee, which is $125 a year. Other rules to understand is that when you borrow from your 401k, your self-directed 401k, you can borrow 50% of the balance, not to exceed $50,000. We often get the question about the amount that you can borrow and how it works. So let's talk about how the $50,000 limit works. And to do that, let's provide an illustration. Let's say Jonathan is self-employed through a self-employed S corporation. Jonathan opens a self-directed 401k, aka self-directed solo 401k. Before he does that, he makes sure to confirm that the plan that he opens allows for solo 401k participant loans. So he opens up the self-directed 401k plan. He funds that self-directed 401k plan by transferring $150,000 from his IRA, his traditional IRA, because you can transfer an IRA as long as it's not a Roth IRA to a solo 401k plan. So he transfers $150,000 with the intention of processing a 401k participant loan. He then reaches out to a solo 401k provider, requests that the loan documents are prepared so that they satisfy the IRS regulations. So the documents are prepared. He decides that he wants to borrow $50,000. Jonathan can borrow the full $50,000 because the loan rules allow you to borrow 50% of your total solo 401k balance, not to exceed $50,000. So even though he rolls over $150,000 from an IRA, he can only borrow $50,000 because the rule is 50% of your total balance, not to exceed $50,000. Let's do another example. Let's say Jonathan instead transferred $80,000 from his self-directed IRA to the solo 401k plan, and he wants to take a 401k participant loan. The maximum that Jonathan can borrow based on $80,000 is going to be 50% of that $80,000. So the maximum he's going to be able to borrow is $40,000. So even though the overall limit is $50,000 that you can borrow, because he only has $80,000, he can only borrow 50% of that, which is $40,000. So that's a good way to understand how that $50,000 works, which is $50,000 or 50% of your balance, not to exceed $50,000. Okay, let's go back to our prior slide here. Again, go ahead and shoot over any questions you have during the live webinar, and we'll answer those questions as they come in. Please also subscribe to our YouTube channel so that you receive more notifications when we go live. We typically go live at least once a day, oftentimes twice a day. But we've been discussing the solo 401k loan rules. Now, when you borrow from the 401k, you're borrowing from your own 401k, which means that the interest and the principal goes back to your 401k. The minimum loan amount is $1,000. The interest rate is typically calculated using the Wall Street prime rate, and then you add 1% to that. You can also use a competitive CD rate and then add 2% to that. When you make the payments back to the plan, they consist of principal and interest. And again, you're paying your own 401k back. So the loan payments don't go to us, they go back to your self-directed 401k. And then they maintain their tax-deferred status. Of course, you cannot take a deduction for making those loan payments, and they're not treated as contributions either. They're treated as loan payments. Therefore, you have to make them with personal funds. You cannot use solo 401k funds or business funds to pay the loan back. You need to pay back with after-tax funds, that is, personal funds. The loan period is typically 5 years. It can be extended to a longer period, such as 15 or 30 years, if you use the proceeds that you borrow towards the purchase of a primary residence. So if you use it towards the purchase of your primary residence, then the loan can be extended from 5 years to 15 to 30 years, depending on your mortgage. Payments are made quarterly, or they can be made monthly. They are paid over that 5-year period, or over that 15, 30-year period if you borrow and use the funds towards the purchase of your primary residence. Also, let's say both spouses are self-employed in the same business, and therefore they open a solo 401k plan that's sponsored by the business. Let's say the self-employed business is taxed as an LLC, or it's an LLC taxed as an S corporation. Let's say that Mary and Joe are spouses, and they both participate in the same LLC. So the LLC would be set up for the solo 401k plan. Let's say Joe and Mary transfer IRAs or even former employer plans to the solo 401k. They can then each borrow from their respective solo 401k funds up to that overall limit of 50%, not to exceed $50,000. So let's say Joe transfers $100,000 to the solo 401k from an IRA or a former employer. He's going to be able to borrow $50,000 through a 401k participant loan. Mary can also borrow 50% of her balance. Let's say she transfers $100,000 from an IRA or a former employer plan to the solo 401k. She's going to be able to borrow $50,000 as well through a 401k participant loan. So that's a total of $100,000 in borrowed funds from the self-directed 401k between both spouses. So one plan, separate holding accounts to hold each spouse's funds under the plan. They each have a participant account that's funded with IRAs or transfers from former employer plans, and then they can each borrow from their respective funds within the plan. Okay, so those are the rules to understand when borrowing from a self-directed 401k plan. Now let's talk about the difference between a participant loan and an early withdrawal / distribution. So when you borrow from the 401k, it's not treated as a distribution. Instead, it's a note payable, which means you need to pay it back to the 401k. It's a liability. Therefore, as long as you pay the loan back pursuant to the payment terms, it will not be treated as a taxable distribution. So it's important that that loan does not go into default. Also, again, before you borrow from that 401k, it's important that 401k loan documents are prepared so that it's not treated as a taxable distribution. What is more, make sure you can borrow from that 401k, that the plan allows for it, because if you think you're borrowing from the plan and you take the funds out and the plan does not allow for loans, that's going to be treated as a distribution, a taxable distribution, early withdrawal. Also, when you distribute funds from a 401k, you have to meet a triggering event such as age 59 and a half or no longer self-employed, for example. Those requirements do not apply to 401k participant loans. You just need to make sure that the plan allows for 401k participant loans. So those are items to understand with regards to comparing a 401k participant loan to an early withdrawal / distribution. Now let's talk about some creative uses of 401k participant loans. So we already talked about how you can use the proceeds towards the purchase of your primary residence. So that's a creative way of getting some funds down for a down payment on your primary residence, for instance, to help towards that down payment. You can also use those loan proceeds for any purpose. There's no credit check when you borrow from your own 401k. So those loan proceeds do not impact your credit stored. When you borrow from the plan, as I stated, you can use the proceeds how you wish. For instance, you can use them for business funding. Let's say you're trying to get more capital for your business, or you're expanding your business, or you're funding it for the first time. You can also use the loan proceeds for, let's say you have high interest credit cards to pay off. You can use it for that. You can even use it to pay off student loan debt or other type of debt, any type of debt. In short, as I stated, you can use the loan proceeds for anything you want. Okay, so those are some items to understand. Again, go ahead and shoot over any questions during the live chat and we'll answer those as they come in. So again, let's talk about some rules to avoid having your loan, your 401k participant loan treated as a distribution. Well, we talked about how you need to make sure that the 401k that you open allows for 401k participant loans. If it doesn't and you take funds out, that's going to be considered a taxable distribution. B, make sure that that loan is documented pursuant to the IRS regulations. If it's not documented properly, it'll be treated as a distribution as well. C, make sure you pay that loan back pursuant to the payment schedule. For example, let's say you borrow from the 401k. It's a 5-year loan term because you did not use the proceeds for the purchase of a primary residence. Therefore, the maximum you can borrow is for 5 years. Let's say you decide to do quarterly payments. So that means that every 3 months, a payment is due. If you miss that quarterly payment, the IRS does provide a very generous grace period, which means that if you miss that quarterly payment, you have until the end of the next quarter to make that payment. For example, let's say you borrow from the 401k in January. That means that your first payment is now due till 3 months from January. So April, if you miss that April payment, you're going to have until the end of the next quarter to make that payment up. So the next quarter would be the end of the third quarter, because April, that's the beginning of the second quarter. The second quarter would run from April, May, and June through June. So you would have until the end of the third quarter. So July, August, September, you would have until the end of September to make up that missed payment that was due in April. But if you miss that grace period, the outstanding loan balance is treated as a taxable distribution, so it goes into default. And that's not the end of it. Just because it goes into default, it does not mean that you don't have to pay it back. You still have to pay it back. So not only is it treated as a taxable distribution in the year that it goes into default, but you have to pay it back. When you pay it back, it's got to go into a separate holding account specifically to make those loan default payments. So later on, when you go to transfer those funds out or close the plan, those funds, you want to make sure they're not treated as a taxable event, because they will have been treated as a taxable event already when the loan went into default. So it's a very quirky rule. But in short, you still have to pay that loan back even after it goes into default, and it's treated as a taxable distribution. Okay, so those are very important items to understand. Now, let's talk about why traditional 401k plans don't allow for participant loans. We touched on the fact that Fidelity and Schwab, for example, offer solo 401k plans, but they don't allow for 401k participant loans. And that's because Schwab and Fidelity have made a decision to not provide a plan that allows for solo 401k participant loans. But a solo 401k from my solo 401k financial does allow for solo 401k participant loans, because we've made the decision to provide a plan that does allow for 401k participant loans. So in short, it's based on the solo 401k plan document provider as to whether or not they will allow for 401k participant loans. Now, the whole self-directed 401k with checkbook control is a way of saying that, hey, this plan allows for 401k participant loans, and that you're going to be able to process that loan by writing a check from that solo 401k because you're borrowing from your own funds. Or you can process the loan proceeds by wire. When you make the loan payments, they go back directly into that solo 401k bank or brokerage account because you're paying your 401k back. And so you've got flexibility when you borrow from a self-directed 401k in that you can process multiple 401k participant loans, but you still cannot go over that overall limit, which is aggregated between all of your loans. So let's say, for example, that Jonathan decides that he wants to take two separate 401k participant loans from his self-directed 401k. Let's say his balance is $100,000. He decides to borrow $25,000, which is okay because it's under that $50,000 limit. So he borrows $25,000. That's going to have its own separate payment schedule, payment terms. Let's say a couple months later or a year later, Jonathan wants to borrow another $25,000. So you add that 25,000 to the already amount to the previous 25,000 that he borrowed. That's still within that $50,000 overall limit. So now we would prepare loan documents for that second loan, and he would make payments to that second loan based on a separate payment schedule. So he would have two participant loans outstanding at one time, both having been processed at different time periods. So the rules do allow for multiple loans. You just can't go over that overall limit. Now, here's one thing to understand. Let's say you have a 401k through your daytime employer, and that daytime employer allows for 401k loans. You can borrow from that daytime employer 401k. Let's say you borrow $50,000 because you have enough funds in that daytime employer 401k to borrow the full $50,000. Let's say you also are self-employed on the side and you open a solo 401k and you fund it by transferring an IRA. Let's say you transfer over $100,000 to that solo 401k. You're going to be able to borrow another $50,000 from that self-directed solo 401k. So now you've got two loans. You've got a $50,000 loan through your daytime employer 401k and the second one from your self-directed 401k. So you can borrow up to the overall limit from multiple 401ks, but that's only if it's not a business that you own. In other words, you're able to borrow $50,000 from your daytime employer 401k because you don't own that business, but you're also able to borrow from your solo 401k because that's your self-employed business. Another scenario where you would not be able to borrow $50,000 twice is if you open up multiple solo 401k plans for your self-employed business, because the $50,000 applies in aggregate to all solo 401k plans for your businesses. So you can only borrow $50,000 across, you can only borrow 50%, not to exceed $50,000 across all of your solo 401k plans. So don't try to get cute and open up multiple solo 401k plans thinking you can borrow multiple times above the overall $50,000 limit. All right, so those are some things to be aware of. Today's topic was, can you borrow money from a self-directed 401k, aka self-directed solo 401k? We'll be live again tomorrow. Thank you for joining today. Until next time, have a good rest of the day.